problem 11.1, we have nightshade sunglasses with variable material cost of $10.48 a unit or per pair. Variable labor cost of $6.89 per pair. Fixed costs are $870,000. They're going to produce 280,000 units this year. Selling price is $49.99 per pair of glasses, and depreciation is $490,000 a year. What is their variable cost per unit? What's their total cost for the year? What's their cash break-even quantity, and what's their accounting break-even quantity in units? So equation, variable cost is simply material cost plus variable labor cost per unit. Total cost or fixed cost plus variable cost. We learned this in basic economics. Our cash break-even quantity is fixed cost plus 0 over P minus V, or contribution margin. And accounting break-even quantity is fixed cost plus D over contribution margin, P minus V. So our answers, our solution, our variable cost per unit is $10.48 per unit plus $6.89 per unit, or $17.37 per pair of sunglasses, variable cost. Total cost are this variable cost times number of units, so $17.37 times 280,000 units gives plus a fixed cost of $870,000 gives me a total cost of $5,733,600. The cash break-even quantity is fixed cost plus 0 over P minus V, so $870,000 plus 0 over $49.99 selling price minus $17.37 variable cost per unit. My cash break-even point is in 26,670.75 units. This is the number of sunglasses I have to make and sell to be able to break even on a cash basis, where OCF equals 0. Accounting break-even quantity is a little bit higher. 870,000 are my fixed costs. 490,000 is my depreciation over contribution margin of $32.62 a pair. That's $49.99 minus $17.37. And for the accounting break-even quantity, I get 44,692.21 units. This is the number of pairs of sunglasses that I must make and sell to break even on an accounting break-even basis, where EBIT is 0, taxes are 0, and MPAT is 0. There are your answers for problem 11.1. In problem 11.2, I have K2 Everywhere Corporation making mountain climbing shoes for $31.85 a pair. Material cost and $22.80 labor cost per pair. Shoes sell for $145 a pair. Production costs are total production is 120,000 pairs, and my fixed costs are $1.75 million. What are my total production costs? What is the marginal cost per pair, average cost per pair, and what's the minimum revenue I would charge to make sure I had a 0 contribution margin on an order of 5,000 pairs? My equations are total cost is fixed cost plus variable cost. The marginal cost, the same as variable cost, is the cost of one more pair, and I get that by adding the material cost per pair and the labor cost per pair. My average cost is total cost over production quantity, and my minimum revenue I would charge is simply my marginal cost times 5,000 pairs. So let's get going on the calculations. My total cost then is the variable cost of $31.85 per unit material plus $22.80 labor. Per unit times 120,000 units, or 120,000 pairs, plus my fixed cost of 1,750,000, I get a total cost package of 8,308,000. I can then calculate my average cost by dividing that number by 120,000 pairs, and I get an average cost of $69.23 per pair. My marginal cost is my variable material cost plus variable labor cost, $31.85 plus $22.80, or $54.65 per pair. And how much would I charge if I got a one-time order of an extra 5,000 pairs? I would take that variable cost times my 5,000 pairs to get a minimum revenue number of $273,250. This would assure, by charging $54.65 in sales, selling price, that I would have a 0 contribution margin to at least cover my variable cost. There are your answers to problem number 2. In problem 11.3, we have Olin transmissions with estimates accurate to plus or minus 15%. The price of their product is $1,400 a unit, variable cost $220 a unit, fixed cost total $3.9 million. Quantity in the base case is 85,000 units. Do a scenario analysis. When I do a scenario analysis, I look for the best case, the base case, and the worst case. So my price is plus or minus 15%, fixed cost plus or minus 15%, my variable cost plus or minus 15%, then my quantity plus or minus 15%. So the best case price, I will take my 1400 base times 1.15 and I get 1610. I will take my, for variable cost, I'll take my base case of 220 times 0.85 and get $187 per unit. I'll take, for fixed cost, I'll take my 3.9 million base and I'll multiply that by 0.85 and get 3315000. And I'll take, my units go up, so my 85,000 units will go up 15% times 1.15 to 97,750. In the worst case, my price goes down. So I'll take my price of $1,400 times 0.85, it'll go down to 1190. My cost will go up. So I'll take 220 times 1.15 to get 253, excuse me, per unit. My fixed cost, 3.9 million, will go up times 1.15 to 4485000. And my units will go down. So 85,000 units times 0.85, and I'll get 72,250. And there are your answers to problem number 3. In problem 11.4, in the previous problem number 3, management's most concerned about price. We had just finished a scenario analysis for them. How should we address this price problem they're worried about? Well, one thing you can do is do a sensitivity analysis just on price. How do you do that? You change the price of the unit, let's say by a penny each or a nickel or a dime per case, and then keep all other variables constant. Then I'll calculate my MPAT, my OCF, my MPVs, and my IRRs. MPAT, or net income, is sales minus cost. OCF is EBIT plus D minus T. MPV is minus the initial cash outflow plus these discounted cash inflows. And then IRR is the rate at which my discounted cash inflows equal my initial cash outflow, or the rate at which my MPV equals 0. So, solution, do a sensitivity analysis on price only. Keep all other variables constant. Variable cost constant, fixed cost constant, quantity constant, keep everything else constant. And calculate their net income, the new OCFs generated, the new NPVs, and the new IRRs. And that's how we would address management concern about price. Do a sensitivity analysis. That's your answer to problem number 4. For problem 11.5, we have a project costing $924,000 with 8-year life. No salvage value. Depreciate this project straight line to 0. Sales of 75,000 units. A year, price is $46 a unit, variable cost $31 a unit. That means their contribution margin is about $15 a unit. Fixed costs are $825,000. The tax rate is 35%. The required rate of return is 15% on this project. Calculate the accounting break-even, the DOL, degree of operating leverage at accounting break-even. Be careful on that because it's at accounting break-even. NPV for a 500 unit decrease in sales, and NPV for a $1 per unit decrease in variable cost. Accounting break-even is fixed cost plus D over P minus V, and degree of operating leverage is 1 plus fixed cost over D, because OCF at the accounting break-even is equal to D. So be careful there with the OCF number that you put in there. You're going to want to put in depreciation because it says DOL at the accounting break-even. OCF is EBIT plus D minus T, and the net present value is the initial minus the initial cash outflow plus the discounted cash inflow. So first of all, accounting break-even is $825,000 of fixed cost plus OCF is equal to depreciation, so that's $924,000 divided by 8. So fixed cost plus D over P minus V, contribution margin in the denominator is $15. I get 62,700 units even as my accounting break-even quantity. Now, what's the degree of operating leverage at that point? 1 plus fixed cost over OCF, and that's fixed cost over D, and I get 8.1429 times. 8.1429 times is degree of operating leverage at the accounting break-even. To calculate my OCF, I must do an income statement. So I plug in my sales, my variable costs, my fixed costs, my depreciation. I get a net income of $119,925. To calculate my OCF, I take EBIT plus D minus T, and I get an OCF of $235,425. $235,425. I should be able to check that by taking NPAT plus D 119,925 plus 115.5, that should be 115.5 in my depreciation number. And therefore I get 235,425 for my OCF. If I have a 500 unit decrease, I have 500 units times 975 a unit, that's my contribution margin. When I take my selling price minus my variable cost, and then that's going to go out for 8 years. So my present value annuity factor is 4.4873. 4.4873 is my PVA factor, which is using my discount rate of 15%, taking it out 8 years. I get a decrease in NPV of 21,875.69 for a 500 unit decrease in sales. And what's my NPV delta for a $1 per unit decrease in variable costs? $1 a unit times 75,000 units times 0.65, which gives me my tax effect after tax, because I want after tax cash flows and after tax NPV. And I get a decrease in, well, actually I get an increase, don't I? I get an increase in NPV of 48,750 if my variable cost goes down. So if my costs go down, my NPV goes up by a total amount of 48,750. There are your answers to problem number 5. In problem number 11.6, we're going to look back to 11.5 and suppose our projections in that problem for price, variable cost, fixed costs, and quantity are accurate to plus or minus 10%. Calculate the base case, the best case, the worst case. Your investment, remember, was $924,000 in this project. Equations we're going to use, we're going to build an income statement. Obviously, to calculate OCF, we need a vertical income statement, and then we're going to calculate NPV. So sales minus cost equals net income. OCF is EBIT plus D minus T, and NPV is just the initial cash outflow plus the discounted cash inflows. In the base case, remember that the price was $46 a unit, the variable cost $31 a unit, making the contribution margin $15 a unit. We have fixed cost of 825,000, 75,000 units was our base case quantity, and then we built the P&L on that case in problem number 5. And got net income of 119,925, OCF of 235,425, and an NPV of 132,427.67. Again, this is all at a required return of 15%. So we would take these OCFs and discount them at 15%, obviously subtracting the $924,000 investment. In the best case, the price numbers and the quantity numbers will be up 10%. So I'll multiply the base case price times 1.1 to get 5060. The cost will be 90% of the base case values. So I'll take the base case values times 0.9. And again, the quantity will be up 10%. I'll just simply multiply my quantity times my price per unit to get my sales, quantity times variable cost per unit to get my variable cost, fixed cost, or fixed cost. And depreciation stays the same. It does not vary, plus or minus 10%. It's always 115,500. My best case net income then is 659,587.50. NPAT in this case is way up to 659,587.50. My best case OCF is 775,087.50, and my NPV is 2,554,066.81. 2,554,066.81. In the worst case, my price is down to 90% of the base case. So my price is 46 times 0.9 or 4140. My variable cost is 90% of, up 10%. So here we're going to multiply by 1.1. So my costs go up. 31 times 1.1 is 3410. 825,000 in fixed cost goes up 10% to 907,500. And my quantity goes down. So it's 0.9 times 75,000 units, give me 67,500 and 500 units even. My sales would then be 2,794,500 just by taking my quantity times my selling price and on down through the income statement. My net income then is negative 344,662.50. Notice that my EBIT is negative, so my taxes are negative because I'm taking 35% of a negative number. That makes my NPAT a little less negative. My OCF is then 229,162.50, 229,162.50, and my NPV is way negative, 1952,325.82. There are your answers to problem number 6. In problem 11.7, we have 3 cases, and we want to find the accounting break-even and the cash break-even quantities. Here are your givens for unit price, unit variable cost, fixed cost, and depreciation, and we simply plug these numbers into these 2 equations. Accounting break-even quantity is fixed cost plus D over P minus V, and cash break-even quantity is fixed cost plus 0 over P minus V. So in this first case, I'll do one case and then you can do the rest. The accounting break-even quantity for case 1, I would take $9 million of fixed costs plus $3.1 million of depreciation divided by 3020 minus 2275 for the contribution margin. I get an answer of 16,242 units for the accounting break-even point. For the cash break-even point, I take fixed cost of $9 million divided by contribution margin of 3020 minus 2275, and I get 12,081 units. Case 2, accounting break-even 44,600 units, and cash break-even 14,600 units. And for case 3, accounting break-even 376 units, and cash break-even 243 units. And again, you can test these. You can plug these quantities back in to the income statement and build yourself an income statement. And in the accounting break-even, make sure that EBIT is 0, taxes are 0, and MPAT is 0. And the cash break-even, make sure that OCF is equal to 0 after building your income statement. So you can test these answers when you're all done with them. There are your answers to problem number 11.7. In problem 11.8, we have 3 cases again. Find the unit price. Here in the second case, find the unit variable cost in the third case, and find the depreciation in the first case for the following accounting break-even quantity cases. So you're given accounting break-even quantities for each of the cases. Unit price, we're looking for, figure that out in case number 2. Unit variable cost, we're trying to figure that out in case number 3. You're given all your fixed costs, and in case number 1, we're trying to find the depreciation. The formula is accounting break-even quantity equals fixed cost plus D over P minus V, or contribution margin, P minus V. So for case 1, we plug in 112,800 units for the accounting break-even quantity. That's equal to fixed cost plus D over P minus V. So 820,000 plus some depreciation number we're trying to find over a contribution margin of $9, $39 minus $30. We get an answer of, for depreciation up here, is $195,200. Case number 2, 165,000 units equals fixed cost of $3.2 million plus depreciation of 115,000 over P minus V of $27, and that P price is $53.36 per unit, $53.36 a unit. And case number 3, 4,385 units equals fixed cost of 160,000 plus depreciation of 105,000 over P minus V. P is the $92, V is what we're looking for. We get a variable cost per unit of $31.57, and there are your answers for the 3 cases in problem 11.8.